So today is our last class. We've covered all of the material. And you see why we're going back to having only two intermediates, because both of them finish up early. They just don't have enough material in them. So we're going to be moving some of the other material in. There's 5 practice questions there, but before you jump on that, some people asked about extra credit. This is strictly optional, even though it shows up as a assignment with a due date. But in your extra credit, I put a case in there, and it's worth 30 points. And it's an ethics case. So basically what you would do, read the draft and then answer the questions. They're short answers and then kind of, your thoughts on the case. So again, should take about 30 minutes if you've had an ethics class. If you haven't, probably take you about an hour. But if you want to do it, it's open and it's available until December 5th. Okay, just make sure this is just the case, and then you have the survey, and the only thing you have to fill out is in the survey. They have questions in the case, but they're different questions than you have to answer, because I had you guys just give me shorter answers. Okay, any questions there? So if you take about 3 minutes to go through these, then I will answer them and we'll get moving on. I told the other students the last week of class, if you would like me to do a little review session, if you email me some questions, I will hold a review session during that last week. Just for the things you're going to be tested on. We don't have I know there's like an optional comprehensive exam, but not a required one. Well, this is an optional for a comprehensive. You still got to take the 12 and 13, but if you had missed an exam, this is like one you would take that would replace that exam. So I know if you're a project-based class, it's a good idea to kind of, especially if it covers what you want to get done out of it, to like say, okay, if you do this project, then you don't have to do the final. But every faculty gets to choose their own. Okay, so let's go ahead and take a look at these questions. If bonds are issued between interest dates, the entry on the books of the issuing corporation could include, and this would be a credit to interest expense. And what that entry would look like is that entry would be a debit to cash or asset. And then you'd have a credit to bonds payable. And then you'd have a credit to interest expense. Now, what does that effectively do when we credit an expense? Nope. It reduces the expense, right? What you meant? An expense is normally a debit. And so when we credit it, it reduces it. So this is the other way that you can have, when you buy it between periods, the issuer credits their interest expense. So when they record their interest payment and their interest expense at that time, this offsets it because it's between periods. Under the effective interest method of bond discount or premium amortization, the periodic interest expense is equal to, and it's the market rate multiplied by the beginning of the period carrying amount of the bonds. Number 3, the generally accepted method of accounting for gains or losses from early extinguishment of debt treats any gain or loss as the difference between the reacquisition price and the net carrying amount of the debt, which should be recognized in the period of redemption. Number 4, note disclosures for long-term debt generally include all of the following except, and the answer would be names of specific creditors. If a company chooses the fair value option, a decrease in the fair value of the liability is recorded by crediting unrealized holding gain or loss in income. So those answers are C, D, 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 and C. Okay, so apply GAAP accounting for extinguishment of debt. And so a couple things to remember. If the extinguishment occurs on an off interest date, accrue the interest and adjust the discount or premium. Okay, so now we're jumping into example 1. At December 31st, the following balance existed on the books of Foxworth Company. Bonds payable, $6 million, discount on bonds payable, and interest payable. If the bonds are retired on January 1, 2021 at 102, what will Foxworth report as a loss on redemption? Okay, so this is on 121. So no accrual for interest or discount is necessary. We are going to be paying $6 million face value multiplied by 1.02. Remember now, bonds being retired at 102 means 102%. So they're going to be paying more to retire the bonds. $6,120,000 And our carrying value equals the bonds payable less the discount So our bonds payable is 6 million. And our discount, 840,000. So carrying or book value is 5,160,000. And so the difference is a gain or loss. We paid more than book value, so it is a loss. And that difference is, I think, 960,000. So letter B. Got a zero there. Let's take a look at example 2, unless you have any questions. The December 31st, 2020 balance sheet of Hess Corporation includes the following items. You guys know what Hess Corporation is? You guys seen the little Hess trucks and stuff? It was like a big staple up in New England until they kind of closed all their stores, but it used to be a gas company, and they would, like gas and oil, and they would do these little Hess trucks. And it's kind of like one of those things from childhood. Sorry, I digress, but you can see years and years of them. It started way back, and they do Hess trucks every year. And so I don't think they exist as a oil and gas company other than like a trading company now. I don't know for sure. Includes the following items: 9% bonds payable due December 31, 2026 of 5 million, unamortized premium on the bonds payable of 90,000. The bonds were issued on December 31st, 2016 at 103 premium, right? With interest payable on July 1 and December 31st. Hess uses straight line amortization. On March 1, 2021, Hess retired 2 million of the bonds at 98 plus accrued interest. What should Hess record as a gain of retirement on these bonds? Ignore taxes. Okay. So we want to find the percentage of bonds being retired. So we had 2 million divided by 5 million. And so that's 0.4 or 40%. You want to find the associated premium, which would be 90,000 times 0.4, which equals 36,000. And so they're being retired on March 1, and they paid interest on December 31. So there's 2 months into the current cycle. So we have 36,000 straight line amortization over 6 years. That's the time remaining on the bonds, right? 2020 through December 2026. And that equals 6,000 per year. So 6,000 times 2 divided by 12 for 2 months. And that equals 1,000. Okay. So the entry would be a debit bond payable for 200,000. Oh no, sorry, 2 million, right? Going to debit premium on bond payable. And so keep in mind, we had 36,000 minus the 1,000. And so our current balance equals 35,000. So we have 35,000. We're going to credit cash, and the cash was 2 million times 0.98. And so that's 1,960,000. And so you have cash paid out 1,960,000 less the carrying value, which would be 2 million plus 35,000, because that's a premium. And so we get 2,035,000. And the difference, we paid less than carrying value. So we have a $75,000 gain. And that answer is C. So what do they call it? Gain on retirement. If you had the other pieces on your entry should balance. So you could take the 2,035,000, subtract the 1960 and get the 75. All I did was just break it out separately. Any questions? Okay, now you got practice question. I'll give you about 3 minutes. I'll wander around the room if you have any questions. So in just looking at the question, if they retired $500,000 in face bonds at 102, so you know that's more than 500,000, right? But their carrying value is 481,000. That tells you that there's going to be a what? We paid more than what we are carrying it for, so this one's going to have a loss. And so I like to illustrate with entries, even though it's not required here. If you're retiring it, you'd have a debit to bonds payable. And we know the face value is 500,000. And we know we're going to have a credit to cash. In this case, they said 500,000 times 1.02. And so that's 510,000. To find the value of the discount, take 500,000 and subtract out the 481,250. And the discount is 18,750. When we create a discount, we debit it, so we have to eliminate it. And so we credit discount on bond payable. And this would be 18,750. And then if we want to find the loss or gain, we paid 510,000. Our carrying value, 481,250. The difference is a loss. And that would be 28,750. So we would have a debit here, loss on retirement bonds payable. And that would be 28,750. Any questions? So now we move to recording long-term notes payable. The accounting is almost the same. Most notes payable use the effective interest method unless it's immaterial or not different from what the straight line or what the effective interest method would be. So let's take a look at example 3. Ann Price loaned $187,825 to Joe Kiger. A 0 interest bearing note. Face amount of $250,000 was exchanged solely for cash. No other rights or privileges were exchanged. The note is to be repaid on December 31st, 2022. The prevailing rate of interest for this loan is 10%. Present value of $250,000 at 10% is 3 years is $187,825. What amount of interest income should Mrs. Price recognize in 2020? So 1/1/2020. $187,825. And then 12/31/2020. We have the interest expense, 187,825. Multiply that by 0.1 or 10%, and that equals 18,783. The full amount, 18,783, is amortized. So we add 18,783, and we have 206,608. And so that tells us our interest expense for the year is our interest revenue in this case. Should miss price recognize. Any questions? Okay, let's take a look at example 4. On January 1, 2021, Crown Company sold property to Leary Company. There was no established exchange price for the property, and Leary gave Crown a $5 million zero interest-bearing note payable in 5 equal annual installments of $800,000. With the first payment due December 31st, 2021. The prevailing rate of interest for the note of this type is 9%. Present value of the note at 9% was $3,605,000 at January 1, 2021. What should be the balance of the discount on notes payable on the books of Leary at December 31st, 2021, after adjusting entries are made? So we had 1/1/21, and the discount 5 million minus 3,605,000 equals 1,395,000. And the carrying amount of the bonds, 3,605,000. And it says each year. So on 12/31/21, we paid 800,000. Our interest expense is the 3,605,000 times our rate, which I think this was 9%. 0.09, yes. 0.09. And so that equals 324,450. And so we have 800,000 minus, wait, hold on, what am I finding here? What should be the balance of the discount on notes payable? Minus 324,000. Sorry, you just take that out of the discount, 324,000. And we equals 1,070,550. So that answer is B. Any questions? Okay, you got practice number 2 here. I'll give you guys about 3 to 5 minutes and then I'll go over it. Okay. So it says, what is the amount of interest income that should be recognized by Jacobs in 2021 using the effective interest method? And so we have to take the carrying value of the, what is this, a note? And that's what, 3,481,800? And we multiply by market rate of interest, 10% or 0.1. That equals interest income of 348,180. Any questions? Okay, so remember, companies can choose to fair value their debt using fair value. Means the balance in the liability changes each year. And so if there is a loss in value, fair value, then we would debit bond or note, or this is note payable, sorry. And then we would credit unrealized gain or loss income. And then if there's a gain, you would debit unrealized gain or loss income and credit note payable. Unrealized gains, loss, income is recorded in other comprehensive income. Oh, excuse me. Scam. Never had my phone on. Sorry about that. Okay. Let's try practice number 3. All right, let's walk through each of these. So 5-year bonds payable at 8%. Is that short-term or long-term? Oh, you guys are all clicking away. Go ahead, finish. Didn't mean to cut you off, I apologize. Okay, so 5-year bonds payable, long-term or short-term? Long-term, good. Interest payable. Everybody gets quiet now. When are you usually going to pay it? You're usually going to pay it short-term, right? Within 3 months, 6 months, a month, short-term. Good. Premium on bonds payable. So we can assume that they're tied to the bonds payable up above. So that's a long-term, good. Notes payable, 3 months, good. Long-term, good. So short-term is 15,000, long-term 185,000. Short-term and short-term. So we add 3 million. Wow, that was awful. Good thing nobody's online to listen to that. 100,000, and since it's a premium, it adds to our carrying value. And then 165,000 and 185,000. So the total long-term equals 3,450,000. You have the fair value option. I don't know what I meant to say about that, but I think I talked about it up above. Times interest earned formula. So it's pretty straightforward. Net income plus interest expense plus income tax expense divided by interest expense. So I know this is set up as practice, but I'll just walk you through it. In the recent year, Hill Corporation had net income of 210,000, interest expense of 50,000, and tax expense of 90,000. So we take our net income, 210,000, add our interest expense, 50,000, and then we add our income tax expense, which is 90,000. And then we divide by our interest expense of 50,000. And I think that's 7.0. What I used to tell people my GPA was when I was in elementary school. 7.0. Better than yours. That's what the plus is for. So now this one's a little tougher. I'll let you try it. Nice of me, right? It's like a couple of you are still working on it, so I'll give you another second. Okay. So the answer is going to be C, and I'll walk you through how we got there. So your times interest expense ratio equals 9, which equals our 750,000 net income plus 150,000 in interest expense plus, and we have to find the tax expense. Sorry. And that's divided by 150,000. So multiply both sides by 150,000. And you end up with 1,000 or 1,350,000 equals 750,000 plus 150,000 plus my tax expense. Combine like terms. So we have 1,350,000 equals 900,000 plus tax expense. And so we subtract 900,000 from both sides. And we get tax expense equals 450,000. We know that our net income equals our income before tax less income tax expense. So your net income 750,000 equals income before tax minus 450,000. And so you add 450,000 to both sides. And your income before tax equals 1,200,000. So if there are no questions, that's it for all the material. And you guys have what I think is a fairly easy chapter 13 team problem, which if you guys get it done by today, you can turn it in before you go. If not, you can upload it to the web by Tuesday. And we are done for the webcast as well. Have a great day.